Okay, in the last lecture we saw CAPM concepts. So in this lecture we will do questions of it. Okay, CAPM questions and beta questions. Okay, there are two topics questions which we need to cover. Okay, so these are basic sums. Okay, question number 11, 12, 13, 14 and 15. This you can do it by yourself by putting the formula, and or else by, if you are getting stuck anywhere, you can easily do it by looking at the solution. Okay, this you will understand very well. I'll do question number, those questions which are quite tricky or which are new. Okay, so that questions only I will do. Okay, so we'll take up question number 16. So we'll start. A company has a choice of investment between several different equity oriented mutual funds. Okay, the company has an amount of 1 crore to invest. The details of mutual funds are as follows. Okay, mutual funds, it is equity oriented, means what? The mutual funds are investing in equity shares only. Okay, the company has 1 crore to invest. So what is it saying? Mutual fund A, B, C, D, E. Okay, there are 5 and there is a beta given. Okay, so what is the required part? If the company invests 20% of its investment in each of the first 2 mutual funds and an equal amount in mutual funds C, D and E, what is the beta of portfolio? So what it is saying, that it wants to invest 20% of its investment in each of the first 2 mutual funds. Okay, A and B, it wants to invest how much? 20%. Okay, and the equal amount in C, D and D. C, D and D, how much is remaining? 20%. 20% is gone. 20 plus 20 is gone. So minus how many lakhs it has? 100. So 60. 60 divided by 3. So equally it is going to be invested. So why didn't it say like that? It's just framing of question. So 20 lakhs it wants to invest in every shares, every mutual funds. Okay, so it is asking what is the beta of portfolio. So what we'll do simple average only, because everyone's share is equal. Okay, so even if we do weights, it will be the same answer. Okay, plus 1 plus 0.9 plus 2 plus 0.6 divided by how much? 5, right? 1.22 I'm getting. Is that the answer? Yes. See, if you see, the answer is 1.22. Okay, the next one. If the company invests 15% of its investment in C, okay, 15 lakhs in C, 15 lakhs in C and 10% in A. Okay, 10% in A, sorry, 15% of its investment in C, 15% in A, okay, and 10% in E. Okay, and the balance in equal amount in other 2 mutual funds. Okay, so how much is remaining? Minus 100, 60 is remaining. So remaining portfolio will get 30, right? So now what? In C it will be 15, in A it will be 15, in B it will be 10. Sorry, A, C and E, right? E it will be 10, B and D will be 30. So we'll take weights accordingly. Okay, see, 15, 30, 15, 30, 10. Okay, weight is calculated accordingly. How will we calculate weight? 15 divided by 100 into 1.6. Okay, so 0.24 is my beta. Okay, M plus, and 1 into 30 divided by 100, 0.3. Okay, so I'm getting the beta as 1.335. Okay, next, what it is asking, if the expected return of market portfolio is 12% at a beta factor of 1. Okay, what it is saying, that the expected market portfolio is 12% at a beta factor of 1. Which securities, which market has 1 beta? It is the market's beta is always 1. Okay, so this is my market return. Okay, will there be portfolio? What will be the portfolio's expected return in both the situations given above? What is the both the situations given above? That is your you calculated beta, right? This beta and this beta. So what will it be? It's asking. Did it give anywhere? There is no risk free securities. Okay, so we will assume that we only have market securities. Okay, so 1.335 into what is my market return? 12. So I'll get 16.02, and 1.22 into what is my market return? 12. So I'll get 14.64%. Okay, so that's what they have asked. So 12 into 1.22, it's 14.64, and 12 into 1.335 is equal to 16.02. Okay, understood? This was easy question. Just for this part, I had to explain it again. Okay. Here there is no risk-free security. That was the only catch. Okay. Question number 17. Treasury bills give a return of 5%. Market return is 13%. Okay. What is the market risk premium they are asking? Okay. So can we find it? What is market risk premium? It is your market return minus your risk-free return. Okay. It is 8. Your market return is 8%. Right. Compute the beta value and required return for the following combinations of investments. Okay. It has given 100 and 0. Okay. So what will be the beta value? If 100% is in treasury bill only, treasury bill means what? It is your risk-free security. So the beta will be 0 only. Okay. If 70 and 30, what will the beta? The beta will be 0.3, because 30% we have invested in the market. What is the market rate of return? It is 1. Okay. So if I've invested 30% in it, so I'll have beta of 0.3 only. So here 0.7 is invested in the market. So 0.7 into 1. 1 is my beta of market. So I'll get 0.7. Here what will be my beta? It will be 1, because 100% is in the market only. Okay. See here, 0% for the securities in bond or treasury bill, and 1 for your security in the market. Okay, so that's what they have asked. Very easy question. Still I've told you. Next question number 18. Here we have just 1 point. I'll just explain it to you with the question. Let's start with the question number 18. Mr. A is having 1 lakh shares of K Limited. Okay, the beta of the company is 1.4. Okay, and Mr. B is the financial advisor who has suggested the following portfolio. So there is a person called as Mr. A. Okay, he has 1 lakh shares in K Limited, and K Limited's beta is 1.4. Okay, now he has approached a financial advisor, and the financial advisor has suggested a portfolio. What it is, we'll see. He has given some securities and beta of it, and percentage of holding also he has suggested for investing 1 lakh. Sorry, for investing. Okay, here they have not given any amount figure. The market return is 12% and the risk-free rate is 8%. Okay, you are required to calculate the following for the present investment and suggested portfolio. The present investment in K Limited and the suggested portfolio, that is the one which Mr. B, financial advisor, gave us. Okay, so we'll calculate individually what was the return. Okay, using CAPM. Now for CAPM, what all we need? We need risk-free rate of return. Okay, we need market return and we need beta. Here market return and risk-free rate of return is given, but beta is missing of suggested portfolio. So first we'll try to take that. Okay, so here they have given percentage of holding, so we'll take weighted average. Okay, 1.2 into 0.1. I'm getting beta as 1.015. So how did I take it? I just multiplied with each of them, okay, in weights. Okay, so I got 1.015. Okay, this is my beta of my suggested portfolio. What is the beta of K Limited, which A has already invested? It is 1.4. Okay, now what they are asking is what is the expected return based on CAPM. Okay, based on CAPM, what is the expected return on both the portfolios? Okay, so we'll see. The first one we'll take off K Limited. Okay, Mr. A has invested on his own behalf. Okay, by using his own brain, he has invested in K Limited. Let's see what is the expected return. Okay, so risk-free rate is 8%. Market return is 12 minus 8 into 1.4 plus 8. So 13%. 12 minus 8 into 1. So 13.6 is the return of on K Limited. Okay, if we invest only in K Limited, that is the amount. Okay, so here you can see, can you see 13.6%. Okay, now next what they are asking is the suggested portfolio CAPM. Okay, so 12 minus 8 into 1.015 plus how much? 8. So I'm getting 12.6%, 12.06%. It is a bit less than investing in K Limited. Okay, now what they are asking is if the market goes up by 2.5%. Okay, so what they are saying is the market return is going up by 2.5%. So 12% we already have plus 2.5. Okay, so they are saying is market return is going up by 14.5%. Okay, market return is 14.5%. How much will be the rate of return as per CAPM? Okay, required rate minus 8 into 1.4 plus 6, 8 is equal to 17.1 if we invest just in K Limited. Okay, like that we have to do in portfolio also. Okay, using the beta of 1.015. Okay, next, if the market goes down by 2.5%. Okay, 12 minus 2.5, it is 9.5 minus 8 into 1.4 plus 8. So if the market goes down by 2.5% in K Limited, we can get 10.1% as return. Okay, what happens in the suggested portfolio? 10.5, what is it? 12 minus how much? 2.5, right? So in this return, what in suggested portfolio we'll got only 9.52. Okay, required return. See, now next what they are asking is if the market is giving negative return. Okay, not only every time it will give positive return, sometimes there will be loss also. So what it's saying is there is a loss of 2.5%. means what? Market return, okay, is 2.5% when it's positive. Okay, so minus 2.5% is the market return. Okay, minus what? Minus your risk-free rate into what? 1.4 plus your risk-free plus 8. I'm getting negative 6.7%. See, I'm getting negative 6.7%. But in case of our suggested portfolio, what will happen? We'll get how much? 2.66 only. Okay. So this is the benefit of having less beta. Okay. We'll be facing loss only up to the times the market goes down. Okay. Now next what they are asking is, if the probability of market giving negative return is more, please advise Mr. A whether to continue the holdings of Mrs. K or to buy portfolio as per the suggestion. Okay. Now what the indications are that the market is going to go down only. That is, the market is going to continuously fall. Okay, it will be in negative only. So it is asking, what should we do? Should we invest in K Limited or portfolio? Okay, since portfolio is having less beta, so we will invest in portfolio only. Okay, so that's what the decision. It was very easy question. Okay. Next we have another good question. It is question number 19. Okay. We have the following details. A holds the following portfolio. Okay, there is a person A, he is holding the following portfolio. There are certain details given regarding share bond, beta, initial price, dividends, market price at the end of the year. Okay, these all information is given. So what is the name of the shares of bond? Epsilon Limited, Sigma Limited, Omega Limited, and the Government of India bonds. Okay, so these first three securities are your shares and the last one is your bonds. Okay, and what is the beta? Beta is everyone, for every share it is 0.8, 0.7, 0.5. But if you see in Government of India bonds, there is meager risk, that is 0.01% only. Okay, so it is almost safe only. Okay, but still it is we are assuming that if the time is in recession, we will have 0.01% risk. Okay, so that's what they are saying. Now calculate the expected rate of return of each security using CAPM method. Okay, so what we need to do, we need to calculate the expected rate of return of each security. Okay, so how will we do it? There is beta given in CAPM. What we need risk-free security, beta, RM. Okay, three things we need. Okay, so here what it is given just what 0.8%. okay, only your beta is given, there is no RM, there is no RF. So how will we calculate it? Okay, we'll see. Okay, there are some other details also given, we'll see what it is. It is initial price, dividend and market price. So we read a formula in Ajay Agarwal's concept book. So what it was, that if you want to find the market, if you want to find the required rate of return of your portfolio, what will you do? Total market value, sorry, not this one, this one. If market related data is not given in question, but data related our portfolio is given in question, so what we need to do, RM is equal to total market value of all securities in the portfolio at the end of the year minus the beginning of the year plus your dividend or interest you have received in the portfolio divided by your initial cost. Okay, that is what we are going to use. Here we don't have any market return, so we will assume that our portfolio is the market. Okay, we will assume that our portfolio is the market. So how will we calculate it? See, now we have been given market price at the end of the time. So how will we do it? For share epsilon, I will show it to you how we will do it. Okay, so 50 is the end of the year minus 25 is the beginning of the year. Okay, so 25 rupees I got return plus 2 rupees I got dividend. Okay, divided by the initial price, which is 25. So what is the return I am getting? I am getting 108%. Okay, I am getting return of 108%. it's for the individual security. But we need to find the market return, right? So what we'll do, we'll assume our whole portfolio as the market, and we will take we'll calculate beta of it, sorry, return of market on it. Okay, so how will we do it? We'll take the total of this end of the year. So 50 plus 60 plus 135 plus 1005 minus 1250, right? 150. 25 plus 35 plus 45 plus 1000. Okay, minus MRC. Okay, I'm getting 145 rupees return. Okay, plus how much is my dividend or interest? It is 2 plus 2 plus 2 plus 140. Okay, so 291 is my total return divided by my original cost. What is my original cost? 1105. So I'm getting 26.33 return as the market return. Okay, I got 26.33 as the market return. Okay, now in question they have given risk-free rate of return. Okay, we already know risk-free rate of return. We know risk of market. Okay, we know beta. Okay, so can we calculate our return on security? Yes. So how will we calculate for each of the case? Okay, expected return of each security using CAPM. So by CAPM we got all the data. Okay, now we'll put the values in each of the security. Okay, so what was my return? 26.33 is my return, right? 26.33 is my return minus what is my risk free? It is 14 into what is the beta of security epsilon? It is 0.8 plus my risk free rate of return. It is 14. Okay, so I'm getting 23.864 in my first thing. Okay, next we'll do all of this. Okay, we'll do all of this. We'll get answer as the following. Okay, this is the total answer we get. Now what they are asking is calculate the simple average return of the portfolio. Okay, simple average return means what we need to do? We'll take total return of all the securities divided by the number of securities. Okay, so total, what is the return? It is 23.86 plus 22.63 plus 20.17 plus 14.12, right? Divided by how many securities we have? 4. Okay, divided by 4. So I'm getting simple average return as 20.195. Okay, it was so easy. Or 20.20. Okay, for you to practice, there is also a question given as question number 20. Same data is given. Okay, just put in the values, you will get the answer. Okay, now we'll do question number 21. Okay, now read with me. Your client is holding the following securities. Okay, in equity shares. Okay, there is equity shares and the name of the shares are gold, silver, bronze and GY bonds. Okay, equity shares are 3 and GY bonds is 1. Okay, this will be my risk-free security and the name of equity shares are gold, silver and bronze. Okay, so now what they are asking is simple average return of portfolio is 15.7. Now at first what we got in mind that we solved 2 questions back. Okay, we always there is a simple average return is asked and risk-free return is given. Here what is happening, they have given simple average return, but what they have asked is expected rate of return in each using CAPM. Okay, and risk-free rate of return they are asking. So without risk-free rate of return we cannot move further for CAPM. Okay, so what is the risk-free rate of return? They have given simple average rate of return. Okay, so how do we calculate simple average rate of return? Simple average rate of return is calculated by simple average return means what? Simple average is what? You do CAPM of each security, right, divided by the number of security, right? This is what you do. Now what they have given they have given this. Okay, they have given this. You need to find this. Can you find it? For that, what data you need? In CAPM, what data you need? You need, to find CAPM, you need what? Beta. Okay. You need beta. You need RF and RM. You need 3 data. Okay. Now, can you find RM? Yes. They have given data here. You'll find RM. Okay. Cost, dividend, market price is given. You'll find RM. Beta is also given in question. Okay. Individual beta is given in question. Now, what you need to do is to find RF. Okay. So, this is a missing figure we need to find. Okay. Using simple average. So, how will we do it? If you put it in formulas, it will come like this. See, so big formula. Okay. RF plus RM minus RF beta plus RF plus RM minus RF beta. Like that 4 times you need to do, divide by 4. This is a simple average rate, 15.7. Okay. If I break it down, you will get this much. Okay. 16.7. Okay, this 16.7 you don't know where did you get. So first we'll find risk of market. Okay, then I'll show you how to find out RF. Okay, so you'll find risk of return first, risk of market first. Okay, so like usual we do. Okay, we'll add all the, we don't have market related data here. So what we do, we add all the, we take our portfolio as a market. Okay, plus 20,000 plus 34,500. Here we are getting 80,500. 10,000 plus 15,000 plus 14,000 plus 36,000. I am getting 75,000. Okay, minus 80,500. I got 5,500. Now plus I need to do a dividend also. This we all did it earlier also, so that's why I am going fast here. Okay, divide by, so I am getting market return as 16.7. Okay, I am getting market return as 16.7. Now I have 2 data. Okay, I have 2 data, market return also and my beta also. I just need my risk free rate. So this you can do. Okay, like that big formula you can do, or else I'll tell you a shortcut how to calculate beta. Okay, beta of all the securities, how to calculate. So what we do is, we'll do simple average of all beta. Okay, 0.6 plus 0.8 plus 0.6 plus 0.01 divided by 4. I'm getting 0.525. 0.5025. Okay, I'll explain it how we got this. Okay, 5025. See, when you do all of this, it is all divided by 4, right? So this all will be added, right? This 0.8, 0.6, it all will be added. Okay, to this. Or else do individually. Individually everything is 4 times, right? It is in multiply. Okay, so that's what it is in multiply. So we can divide it with the number in the denominator. Okay, so 0.6 divided by 4 m plus 0.8 divided by 4 equals m plus 0.6 divided by 4 equals m plus 0.01 divided by 4 equals m plus. You'll get the same answer. Okay, 5025. Okay, I just did directly. I added all of this and did one time only, divide by 4. Okay, so you got that. Okay, so now it will be very much easy. Okay, so now simple average is 15.7% is equal to CAPM RF we don't know plus beta we know. Okay, what is the beta? Collective beta 0.5025, right? This is the collective simple average, right? So we have to take collective beta also. Okay, RM we know 16.7 minus RF we don't know. Okay, now we can solve this equation. Yes, so RF we get how much? 14.7%. Okay. Now next what? So that's it. We have to find the risk-free rate of return, and we'll get expected return of each security they have asked. Okay. We'll use risk-free rate of return plus market return minus risk-free rate into the beta of individual securities. Okay, individual securities we do, and we get expected rate of return of each security. Okay, so this was a case of reverse calculation. Okay, it was good question. Next, question number 22. Okay, suppose one of your HNI clients is holding the following portfolio as per his risk appetite. Okay, so here's equity shares of GSB Limited, GSB individual shares of number of securities they have given 1,500. Okay, and PSU bonds he has 20,000. Now what they are asking is the other data related to each of these securities per share or bond is also as follows. Okay, other data they have given as cost, dividend, market price, beta. This we can use to find out the market return. Okay, that we used in previous sums, right? Okay, your client is interested in investing in some more funds in bonds issued by GOI. Okay, in Government of India bonds, our client is interested. Estimate the minimum rate of return that your client would expect from these bonds, keeping in mind his risk appetite and assuming risk market return as 12.07%. So now what they are given is they are given market return. Okay, so what is this data given for? This data we should not use, because already market return is given. We will not assume our portfolio as the market. So this will be used purely based on for our calculating the return of portfolio. Okay, so now what they are asking is what is the minimum rate of return your client would expect from these bonds, keeping in view his risk appetite. Okay, what is the minimum rate of return you would expect is what they are asking. Okay, our market return is 12.7%. So now what we need to do, we need to find out the minimum rate of return that your client would expect from these bonds, keeping in view his risk appetite and assuming market return as 12.7%. So what we need to do is, first we need to find the beta of security. Okay, minimum rate of return is asking. Okay, here beta is given, but we need to find beta of portfolio. So how will we find beta of portfolio? Beta of portfolio, we'll use weighted average. Okay, simple average, when the question asks, we provide simple average, or else we'll have to take weighted average only. It is the logical one. So what we do is, first we'll calculate the portfolio beta. Okay, how will we calculate? Our security GSB, okay, investment amount. Okay, we have to give weights to it. Okay, so number of securities 1,000, 1,500. Okay, and the market price, sorry, the cost. Okay, so the cost we'll take first. Okay, so investment amount, how much is it? 1,000 into 10,000. 1,000 into 10,000, it comes to 1 crore. Okay, next 15,000 into 1,000, we'll get 1.5 crore. 28,000 into 500, we'll get 1.4 crore, and 1,800 into 20,000, we'll get 3.6 crores. Okay, now this is my initial investment amount. Okay, now we'll assign weight to it. Okay, and we'll multiply beta and we'll get beta portfolio. Okay, 0.40. Okay, next we need to find portfolio return. How will you find portfolio return? The investment amount minus the market price at the end of the period. Okay, market price. Okay, then we'll take dividend. Okay, then what we'll do, dividend plus difference in market price, that is end minus initial. Okay, then divide by initial amount. So how much we are getting? 8.9%. Okay, this is my portfolio return. Now what they are asking is minimum return on GY bonds. Okay, so how much should we expect? So we got return on portfolio as 8.9%, right, is equal to RF plus RF we don't know. Okay, we want minimum return on GY bonds. Okay, so beta of portfolio we know for it is 0.4. Okay, and we know RM 12.7 minus RF. If we get, we'll get if we do this, we'll get RF is equal to 6.37. Okay, this is my minimum return on GY bonds. Okay, now what they are asking is analyze whether this portfolio has outperformed the market or not, assuming risk-free rate of return is 7%. Okay, now they are asking is whether our portfolio has outperformed the market. So what is the return we got? We got 8.9%, right? We got the return as how much? 8.9%. We got the return as how much? 8.9%. Okay, what is the portfolio? What is the market return? It is 12.7. Okay, so market return is 12.7. Ours is less. Okay, so we have underperformed. Okay, assuming risk-free rate of return is 7%. Okay, this what we are doing is 8.9%. How we are getting is for RF we have substituted as 7%. Okay, and beta will be same, RM will be same. Okay, RF has changed. Now the new return of portfolio is 8.9%. Okay, so that's why the share has been underperformed. Okay, next question number 23. X Limited has substantial cash flow and until the surplus funds are utilized to meet the future capital expenditure likely to happen after several months are invested in a portfolio of a short-term equity investment, detail for which are given below. So XYZ Limited has currently more funds in their hand. They want to meet future capital requirements, but they have currently funds now. So they want to invest in short-term securities and get the money after few months with the market return. Okay, so they want to invest in short-term equity, that is less than 1 year. Now they have 4 investments. Okay, number of shares is given, beta is given, market price per share is given. Okay, and expected dividend yield is given. Okay, now this will form my expected return. Why? Because it is short term. Because the equity is short term, we will not get dividend at the market price at the end of the year or beginning of the year. Okay, and the data is absent also, so we will take this as expected return. Okay, now the current market return, this is the expected dividend yield. Okay, this is how much is expected that we will get dividend. The current market price is 19% and risk-free rate is 11%. Okay, so now what they are asking us, calculate the risk of XYZ's short-term investment portfolio related to that of the market. So they are asking me the risk of short-term investment portfolio, that is this portfolio risk they are asking. Okay, so how will we do it? Risk. So risk of portfolio will be so what they have asked us, the question is the investment portfolio risk. What is the risk? Risk is beta, right? So beta risk, how much are we getting? So first what we need to do is find out the portfolio beta, okay, and we'll calculate our CAPM equation, okay. So first what we need to do, we need to find our portfolio of, sorry, beta beta of portfolio, okay. So question number 23, I will do beta of portfolio, right? So securities 1, 2, 3, 4 is given, and what number of shares is given, right? What we'll do, we'll just take investment amount directly, okay. We would have invested this amount, right, number of shares into market price per share, okay. So I'll directly take invested amount, okay. So 60,000 into 4.9, 4.29, it is 257,400. 80,000 into 2.92, 233,600. 1 lakh into 2.17, it is 217,000, and 1,25,000 into 3.14, I'm getting 392,500, okay. This is my investment amount, right? So what we are finding here is, we are finding that how much is the beta of portfolio and how much is the beta of market, okay, and we'll compare it and we'll see how much is the risk, okay. If you are asking me that how will we know if it is a Markowitz question or sharp question, so here there is no zikr, there is no mention of CAPM here, but here they have given here beta, okay. There is no beta in Markowitz, okay. So like that you can find it, okay. Now we'll take beta of individual securities is how much? 1.16, 2.28, 0.9 and 1.50. So what is the total of this amount? It is how much? 11. We'll take 257 400 plus 233,600 plus 217,000 plus 392,500. It is 11,05,000, okay. So we'll assign weights to it so that we can find beta of portfolio, okay. What is the weight? 257,400 divided by 11,0500 into 1.16, it is 0.0269, okay. Take 3 digits or 4 digits, okay. I am taking 4 digits to be on the safer side, okay. Now we got the weight how much we are getting? 0.2123, okay. I am writing it directly, you calculate and write 1972 and 0.3566, okay. What is my beta of? Now we'll calculate, let's assume this is 1, this is 2 and this is 3. Now we'll calculate 2 into 3, okay. We'll get product, what will get? 1.16 into 0.0269, we are getting 0.0312. Like that if we do, how much will we get? Wait a second. If you are seeing here, I just took what? I just took investment amount, right? But is this right? Because in question they have given us expected yield, okay. So if we are going to calculate the weighted average of securities, so this will also form part of my weight, right? So we have not given effect here, so we'll take also that effect, okay. So these weights are wrong, okay. these three will be right, but this one will be wrong. Why? Because I have calculated it and this three is from solution. Okay, so now what we'll do, we'll calculate dividend. How much will be the dividend? It is dividend yield. Okay, dividend yield means what? It is on market price of the share. What is dividend yield formula? It is DPS upon MPS. Okay, how much dividend are you earning compared to your market price of the share? Okay, so here we have total market price, right? 257 400 into how much? 19. 257 400 into 19.5%. Okay, so 50193. I'm getting dividend 56064, 37975, 102050. Okay, this is the dividend I'm getting. Okay, now what is my total weight? Total market price is equal to how much? 257 400 plus 50,193, right? So it is 307,593. Okay, so like that you will calculate all of it and we'll get what? We'll get weight. Okay, what is the weight? Weight will be 0.2339, 0.2123. We'll take 4 digits. Okay, in weights we'll take 4 digits. 0.1972, 0.3566. Okay, now we'll calculate it. Now we'll multiply it with beta. 1.16, 2.28, 0.9, 1.5. Okay, now we'll get weighted beta. I will get 0.27, 0.48, 0.18, 0.53. We'll get, if we total it, we'll get beta. So the beta of our portfolio is how much? 1.46. Now what they have asked is, calculate the risk of short-term investment portfolio. Okay, our portfolio we have calculated relative to that of the market. The market beta, anywhere it is given or what? No. So what we'll do, to calculate market beta, what we need? We need our CAPM, right? Our required return. Okay, we need risk-free security. We need RM. Okay, so do we have CAPM? I don't know. Risk-free we have 11%. Risk of market we have 19%. Right? It is given in question. Market return 19 and risk-free is 11%. CAPM we don't know. Okay, that is our required return. Required return we don't know. So what we'll do is, we'll calculate required return. Sorry, return of portfolio. Okay, how much return am I getting from having this much risk in portfolio? So how we'll do it is, we'll total the return. Okay, this is my return, right? Dividend. So how much total am I getting? It is 2,46,282 divided by my invested amount. How much did I invest? 11,005,500 without the interest, without the dividend amount, right? So this is the amount I invested. I got return of this much. So how much return is it making? 246,282 divided by 11,005,500. It is making a return of 22.38%, right? Now what we'll assume is that this is what? This is my actual return. Okay, actual return or expected return. What does Sharpe assume? Sharpe assumes that expected return is equal to required return. Okay, so what does CAPM get us? CAPM gets us required return. So we'll assume as 22.38 as my required return, and RF do we have? 11%. Okay, 11 plus beta we don't know. we are finding the risk of market. Okay, next, if I want to get that, what are we checking is, if I want a return of 22.38 like in my portfolio, how much beta will I have in the market? Okay, as per the given data is what we are finding. Okay, 19 minus 11, 19 is given in question. Okay, so if you solve it, we'll get how much. This is 8, 19 minus 11 into beta, right? 8 beta is equal to 11, or else 8 beta is equal to 22 minus 0.38 minus 11, we'll get 11.38. okay, beta is equal to 1.4225. Now, as per the given data in the question, as market return is 19%, okay, and if you want a return of 22.38%, we have a beta, that is the risk of 1.4225. okay, but here in our portfolio, how much return are we getting? Sorry, how much beta are we getting? How much risk are we getting? Beta of portfolio is equal to 1.46. okay, since this is more by how many? 1 point. Since beta portfolio is more than 0.375, it is riskier. Okay, now the next thing they are asking is whether XYZ should change the composition of portfolio. Okay, so they are asking is whether the composition of portfolio has to be changed. Should it be changed? Okay, we'll see. Okay, as per, we'll calculate, we'll give decision based on that. Okay, we read some points, right? We read some points here regarding decision making. We read some point that whether the company should change composition of its portfolio, which means what we need to do, we need to decision making based on CAPM. okay, so now what we'll do, we'll calculate CAPM for each security. Okay, how will we calculate? Let's see. For security investment 1, we have 11% and 19%. okay, 19% is my RM, RF is 11%, and we have risk free rate. This is all given in question into the beta of first security. What is the beta of first security? 1.16. like that, if we do all of it, we'll get some return. Okay, now we'll just take return of it. Okay, I'm just taking return, required return and expected return. Okay, required return is how much? We are getting 20.28 as required, 29.24 as required, 18.20 and 23. okay, 1 2 3 4. okay, now what is the expected return? The expected return that we got in the question, how much we got expected return? In each security did we get expected return? Okay, in question they have given what? Expected dividend yield. Okay, dividend yield will be my expected return. Okay, so what they have given is 19.50, 24, 17.5 and 26. They have given in question only. Okay, this is my expected return. Now what is happening? Now we have to give our valuation and decision. Okay, so now this this is more, required return is more. Okay, required return is more, required return is more, and here expected return is more. Okay, expected return means what? It is what we get, we will get, we will get when we invest. Okay, this is the actual return, and required return is what we want. Okay, we want 20.28, but we are getting 19.5 only. So what it is overvalued, right? So we'll sell. Okay, next 29.24 we want, but we are getting only 24, so it is overvalued, we'll sell. Next 18 point, same, it is overvalued, so we'll sell. Next, so this one is undervalued, so we'll buy. Okay, so this is the decision you need to give. Okay, so what they have said is, in case of investment 4, the dividend yield is more than the corresponding, so XYZ Limited should increase its proportion. Okay, we should increase the proportion of fourth security, increase proportion. Okay, so that's it for this thing. That's it for this lecture. We will continue in the next lecture. Bye bye.